financial advisor and best-selling author, and we are here to talk about the stock market. I am really excited, not only for the topic, but we actually won something. So we won the Plus Award for Best Investing Content. I say we actually won something because I've never won a Plus Award before, and it is the Oscars of personal finance. It is like the top award that you can win, which is really cool. Shout out to y'all, because I do this for y'all. I answer y'all's questions, and that's the content that we put out. So I really appreciate y'all for following, for liking, for subscribing, for commenting and asking questions, because again, it is you guys that create the content. I just explain it the best way I can. So shout out to y'all. This is y'all award as well. I'm really over the moon, but also it's a perfect time for the stars to align to win my very first Plutus Award, because tomorrow, which is September 24th, is my business birthday. That is Building Bread's birthday, and I started this from my dorm room. I think I talked about this before, but like started my dorm room, did like PowerPoint presentations, and you know, 2 people came. And it wasn't until I bought what felt like $100 worth of pizza that I could get enough people to lobby to actually talk about budgeting and finance and investing and stuff like that. And I just kept at it over and over again. 3 books later, hundreds of thousands of followers later, that things started to add up, and we were really able to evolve. Even, for example, the reason we have this nice camera now is because of you guys. Because y'all said y'all wanted more stuff on YouTube. Y'all wanted better video stuff. So here we are. So again, this is all led by y'all, the audience. I'm just the person to explain whatever questions that y'all are asking. So in light of that, or in fashion, or however you want to say that, today I wanted to tell you my top 5, my 5 favorite dividend investing vehicles. They're not all stocks. Some are ETFs, some are REITs. So I'm just kind of putting out a blanket term. Now, I'm going to give you my favorite. Now, these don't necessarily mean they're the absolute best things out there. You might find some that are better for you. Totally fine. I'm just giving you my favorites. You can take that, do whatever it is you want to do with it, compare, notes, whatever it is. So I just want to give you my 5, tell you why I like them, kind of how I came up with these, and then we'll take it from there. All right, so dividends. Let's describe what dividends are first, and then we'll move forward. So companies that we invest in, for the most part, they are supposed to be profitable, right? It's not always the case, but we want them to make money. And when a company decides to pay a dividend, they're essentially saying, look, I am rewarding you for being a shareholder, for believing in us, and being an investor. So when we make a lot of money, we're going to take some of that money and give it back to you, the investor. Generally, these are broken up into different payments throughout the year. For example, let's say that I get a $1 dividend. That means that $1 is really going to be split out in 4 payments called quarterly payments. So every 3 months, I'm going to get 25 cents for every 1 share that I own. So if you look on, Yahoo Finance or Public or whatever, it'll tell you what the previous dividend was. You really want to divide that by 4. That's how you're going to get what your dividend expected. So for every 1 whole share that you own, you are going to get that dividend payment. If you have a fractional share, you get a fractional piece of that dividend. So if I own a half a share, then I'm going to get a 50-cent dividend broken out 4 different times. That is how it works. So fractional shareholders still get a dividend. So you should still get fractional shares if that's what you want to do. I think it's still very beneficial. Now, not all companies pay dividends. Why is that? Because that money that they pay you and us as dividend holders, they could just take that money and invest in better equipment, right? That's something that they could do. And some companies take that approach. It's usually, not all the time, it's usually tech companies that say, all right, well, I want to grow aggressively. I got to be on the cutting edge of technology. I don't want to pay dividends to people, even though that'd be great. I want to take it and make the next big thing and really do that research and development and become even bigger and better. That's an approach that you can use. Other companies is usually more mature companies. Think of something like a Johnson & Johnson. You're not going to see that much growth, but they are going to pay a pretty healthy dividend. They're as big as they're going to get, and the way that they view themselves is, if I pay good, healthy dividends and that dividend continues to grow every year, then investors are going to stick with us. They're not going to leave, and they're going to continuously keep us at a decent level and a decent growth level from a stock perspective, which helps the CEO get paid a bit more. But dividend stocks are usually for established companies, investors who want that passive income. I will say that I personally do not say, oh, it has a dividend and it must have a dividend for me to invest. I like it when I can get it. I personally like to reinvest those dividends. I think I did a video on that, which shows it can significantly increase your gains. So you can make a bit more because you're taking those little fractions, the little 25 cents, adding it to that share. Share grows, taking the 50 cents, add it, and it grows and it grows and it grows. So personally, I send all my things to dividend reinvestment. Some people like to just collect that money and use it for vacations, or that's just how they live off the dividends. I've had clients to do that as well. Whatever approach works for you, but you need something that has some decent dividends. So let's go ahead and get into it. So I have my screen here. These are my favorite five, my top five. So the first one is an ETF. We talked about ETFs before, exchange traded funds, collection of stocks all together. And the ticker symbol for this one is NOBL. It is, I just want to read it off the screen here. It is the S&P 500 Dividend Aristocrats. And this is probably one of the most popular ETFs for dividends, and it has a really interesting approach, which I really like, and it really kind of signals how particular and important dividends are and like how they went through this selection process. So here you go. I'm just going to read it from their website. So excuse me. NOBL, so this is the Dividend Aristocrat ETF. It focuses exclusively on companies that are in the S&P 500. It's a rare breed, it says, of companies within the S&P 500 that have raised their dividends for at least 25 consecutive years. So remember, when I'm talking about stability, this is what this ETF looks for, and especially older investors who, again, rely on that income and really want those payments, they want stability. I don't want to wake up and feel like they cut my dividend for some reason. These are companies that raise their dividend for 25 years at the minimum to even make it inside of this ETF, which is a good sign. All right, so they raise it for at least 25 consecutive years, with most growing dividends continuously for 40 years or more. So if you have reached those criteria as well as some other things, that's how you get inside this ETF. I want to say that I have like 100 and something holdings, if I'm not mistaken. I have a list here, but I'm not going to sit here and count. But they do, if you go to their website, just type in NOBL, it'll take you to a website and it'll tell you how many years each company has consistently raised their dividends, which again, that is a sign of strength. If you got money to pay me and I get a raise every year for at least 25 years, can't really complain about that. So it's been out for a while. It has companies like AT&T, it has companies like 3M, has companies like Chevron. Again, I don't love all these companies that are in it, but again, if I'm looking for dividends, that might be one of the best places for you to go, because you're really spreading your risk there and you don't have to go through and pick some of these individual companies. So there you go. One other thing that I didn't mention about dividends too before we continue. So quick break about dividends. Remember that when we talked about, let's say I get one full share price is $25. And let's say the dividend for that is $1. So it gives me, what, 4%? That's a 4% dividend yield. So you take, math teacher, I don't have a board, didn't feel like connecting all that stuff, but you take $1 divided by $25, that should give you 4%. That's the dividend yield. So a lot of people compare dividend yields and say, the higher the yield, the better it is for me as an investor. Not necessarily, because the way that math works is the smaller the denominator, which is the number on the bottom, the bigger the dividend yield, which means that the price of the share is, the price of the stock is falling, then it's going to artificially look like you are getting paid more when you may not be. So for example, we got a $1 dividend for a $25 stock. Well, if the stock drops from $25 to $20 a share, and I still get the $1 dividend, now it looks like I got paid more because it's a 5% dividend yield. So don't get caught in a dividend yield trap where you're just looking for the highest yield. You want to really do your research and say, is the company still rising? Okay, is the dividend still the same? And like, how healthy is the company? Is that dividend increasing? Those are the things you really want to pay attention to, which is why I don't just say, oh, it has a dividend, I have to invest in it, which some new investors think that is the absolute way to go. It's not a bad way to go, but I think there are some things that you can do better, which is why we're going for these particular companies that I have, or these particular investments rather, that I have on the list. So when I created this list, kind of a quick list, but again, these are some of my favorites. Some of these I do own, some I want to own, and you know, I might buy into some of these. If I do, I'll let you know. So back to the 5. So we've got the Dividend ETF, the Dividend Aristocrats, NOBL is a ticker symbol there. Next is AMT, American Tower Reit. Been telling y'all. That's all I really need to say. Go back to yesterday's video to learn a bit more. Remember, I'm looking for dividends and growth. So for NOBL, and let me just double check this. So over the past 6 months, it's grown 5%. Now the overall stock market has grown 11.55%, close to 12%. We'll just call it 12. But again, remember, dividend paying investments don't usually, not all the time, they don't usually keep pace with the S&P 500. They grow a little bit slower because they're taking all the money they could be investing to grow quickly to pay to you. So again, it's a different little focus there. The dividend ETF, just 5%, 5.87, so we'll call it 6. Goes 6% in the last 6 months. And then compare that to American Tower Reit, same 6 months, it's up 29.9%. We'll call that 30. Okay, so just throwing it out there. Now, they have different types of risks, right? So again, you don't want to just say, well, I'm just going to get American Tower Reit. Well, that has different risk because that is a real estate investment trust versus an ETF that has dozens and dozens of companies that have all types of different risk in it. So take that for what it is. But for growth perspective and dividends, I would say that AMT is a clear winner here. But those are 2. Let's go to number 3, Lowe's. Y'all know Lowe's, the repair store, home improvement store, not repair store. They're up 14%. They pay a healthy dividend. They're also inside of the Dividend Aristocrats, which again kind of gives you a little bit of an extra check mark. So if you want to take on a little more risk, you can say, look, I'll just go with Lowe's, one company that most of us, I believe, understand has a healthy dividend and has grown 14, close to 15%. Still think they're obviously strong. Again, they're inside the Dividend Aristocrat. I want to double check and see real quick. They have raised their dividend for 46 years consistently. Damn. So that is really interesting. They're inside the Dividend Aristocrat, so that's why I know that number. Well, I didn't know it was that good, but that's a company that you can look forward for clearly, obviously consistent, solid dividends there. And then 14% growth is pretty solid. 14, almost 15% growth is obviously pretty solid as well. As we deal with both the housing market, perhaps we'll see more housing supply. I've kind of put out my theories there, as well as we'll see what happens to the infrastructure bill. There's a lot of things that can continue to help Lowe's grow. Now, I don't necessarily think it's going to be, 20, 30, 50% growth every year, but again, good, solid double-digit growth over the last 6 months, and clearly a strong history of dividends, 46 years in a row they've raised those dividends. And now I'll give you the year performance for all of these. All right, then you've got, so NOBL, AMT, Lowe's. The next one is SDY. That is, I want to pull up the name of it here. That is the Spyder Sp Dividend Etf. So it's basically tracking the high dividend yield index. So you got the S&P 500, and then you're tracking the best dividend companies based on yield. Well, I know we just talked about yield, but this is what the ETF does, is track those companies and kind of give you that performance. It tracks what it says 118 individual stocks inside of the S&P 500. So you get S&P 500, tailoring it down to basically what they think is the top 118 in terms of dividend. Now, this ETF, obviously you diversified, it has different risks as we mentioned earlier, but SDY is up. Actually, SDY is down. I'm sorry, it looks like it's down because it's so far down on this chart, but it's up only 1.56%. Okay, you get a great dividend, but it's only up 1.56%. So you do with that information what you choose. Some of the companies in here, AT&T, AbbVie, Chevron, Realty Income Corp. So some companies you've probably heard of, some you may not have heard of, some you like, some you might not like. So I'm looking here. The dividend yield here is 2.65. That's okay. But again, strong dividends. That we know for a fact. 118 companies. Feel free to look more and research there. Then the last one, we talked about this for the REITs yesterday as well. This is IRM. This is the Iron Mountain REIT. This one is up last 6 months, 22%. And I'll get you the dividend yield for that one as well. IRM. I didn't have time to pull up all of these all at the same time because I wanted to make sure I got this out at a decent hour. Can't be up all night. Can't do it. So we've got a dividend yield of 5.52, which is about $2.47 per share, which again that's decently healthy. The stock right now is $44.79. So those are my top favorites. I'll go in terms again, just starting at the top, working down in terms of return, and then I'll give you for 6 months, and then we'll do a year, and then we'll close out. So at the top, you got AMT, 30% gain. You've got IRM, Iron Mountain, at 22% gain. Then you've got Lowe's at 15. I'm rounding up a bit here. It's 14.84. You got the stock market by itself at about 12. Then you've got the Dividend Aristocrats, NOBL. That one is at 6%. Then at 5, you have SDY at the bottom at 1.56%. And that's only the last 6 months. I'll give you a year. Then I'll let the lesson, the sermon, whatever it is you want to call it, be yours. And then we'll finish out here. Alright, so over the past year, which I think gives you a little bit more context, you got last 6 months, you got a year, you can make your decisions from there. Obviously, you want to read up and read up for all of these. Alright, so Iron Mountain is at the top in this case at 65% gain, which again, it's making me really look hard at Iron Mountain. I've been saying that, okay? I learned about it when y'all learned about it, which was yesterday. Did my research, and I like it. I like it a lot. So I'm going to go do more research and make a decision. When I make a decision, I'll let y'all know. So there's Iron Mountain. Then you've got the stock market at this point at 32%. So it's really, Iron Mountain is the only one in the past year that has outgained the overall stock market. Again, context, these are dividend paying investments. That's their focus. The focus is not gains. I personally like to get both, but that's just being clear here. All right, so you've got 2 at about 28.5%, basically 29%. That is SDY. So over the past year, we're talking about close to 30%. That's not bad. As well as Lowe's also get you close to about 30%. Then at 25% gain, we have the Dividend Aristocrat Etf. That's pretty solid as well. Then we got AMT at 21%, and then no, that was all 5. Yeah, that was all 5. So you got again Iron Mountain way at the top at 64. Then you come down, you have 2, which makes 3 total. Both Lowe's and SDY right there at that 29% range. And then next to that, you have 25, which is the Dividend Aristocrat, and then 21% gain, you have AMT. So notice how AMT goes from the last 6 months at the very top to last year, kind of near the bottom. So again, 1 year versus 6 months, you can make those determinations for yourself. I obviously already own AMT. I don't own any of the others, but I am interested in Lowe's now. I am interested in IRM, which is Iron Mountain. The last thing I'll say too is remember, even though it's underperforming the market as a whole, these are dividends. So if I'm looking for dividends, I'm kind of giving that up by receiving what we would perceive to be consistent payments, consistently strong payments. So for like a Lowe's, I'll take 30% or 29% gain is what it's at. I'll take that, which is extremely good, by the way, but I'll take that, which is slightly less than the market, but take these gains, or not the gains, but I'll take these higher than average dividends. So that's the kind of thing that you're giving up. You're getting what we think to be consistent and not guaranteed, but close to guaranteed. 46 years you've been paying out a dividend. You should be continuing to pay that. So there you go. Those are my favorites. Those are my favorite 5, and then you can kind of cut it and give me 3 if you want. That would be AMT, IRM, and then Lowe's. So Lowe's up the street for me, so I might be a little more biased there. So I'll be doing my own research to see if I want to pick up one or both of those. We'll see where things go, and that's it for me. Talk to you guys. Oh. Make sure you click the link below. If you haven't signed up for my free class, you definitely want to do that. It's free, and I'll show you how to create your 6-figure investing plan. All right, now I'm done. Bye.